Welcome to this explainer. I'm so glad you're here today because we've got a really fascinating financial deep dive lined up for you. We're going to unpack one of the most talked about funds in the Indian market right now, the ICICI Prudential Multi-Asset Fund. Whether you're a seasoned investor or maybe just someone trying to figure out how to structure your core portfolio for the next decade, you're definitely going to want to pay close attention to how this specific scheme actually works. All right, let's jump right in.
So think about this for a second. What if you could invest in equities, debt, gold, silver, and even real estate investment trusts, REITs, through just a single mutual fund? Sounds pretty amazing, right? Just imagine having total portfolio diversification without the headache of managing 5 different brokerage accounts, tracking all those different asset cycles, or having to manually rebalance your investments all the time. Well, that is the exact dream scenario the ICICI Prudential Multi-Asset Fund attempts to deliver. But before we get into how it actually performs under the hood, let's cover some quick housekeeping.
All right, before we really get into the weeds, please note this mandatory disclaimer. This explainer is strictly for educational and informational purposes only. It absolutely does not constitute investment, financial, tax, or legal advice. As we always need to remember, mutual fund investments are subject to market risks, and past performance is definitely not a guarantee of future results. Please make sure to consider your own investment objectives, your risk appetite, and your timeline. And always consult a SEBI-registered investment advisor for personalized advice before putting your hard-earned money into the market. Okay, with that out of the way, let's get back to the good stuff.
Now, what's really wild about this fund is this staggering number right here, 86,785 crore rupees. That is the fund's massive assets under management as of July 31st, 2026. This isn't some new experimental fund trying to prove itself, you know? It was launched way back in 2002, and it's grown to become one of India's absolutely largest funds in the multi-asset category. The sheer scale and popularity among Indian investors are just undeniable. The AUM has been growing steadily month over month, jumping from around 84,200 crore in May to 85,000 crore in June, and approaching that massive 87,000 crore mark by the end of July.
But that massive size actually brings us to a really fascinating central paradox. Despite it being an absolute titan in the industry, the fund's short-term performance is raising a few eyebrows lately. As of August 2026, while the long-term numbers look fantastic, the recent one-year return is only hovering around 9.2 to 9.5%, and that's notably below the multi-asset category average of over 14%. So it really begs the big question. Is a fund of this enormous size losing its agility? Can it still serve as a solid core fund for long-term wealth creation? Let's take a closer look at the data.
A very clear story starts to emerge when you look at how this builds across different time horizons. Over the one-year period, yeah, it's definitely lagging, 9.22% against a category average of 14.18. But stretch your timeline out just a bit. At 3 years, it's virtually neck and neck with the category average at over 16%. Now look at the 5-year and 10-year marks. Over 5 years, it boasts a 17.40% return compared to the average of 13.47, and over 10 years, it's 15.90% versus 12.53. So that initial one-year lag completely transforms into significant, robust outperformance over the long haul.
Which leads us directly to a super important takeaway. This is clearly not a fund that should be judged on 1 year's performance. The entire objective of a multi-asset fund isn't to win a short-term sprint or to beat pure equity funds every single year. Its true purpose is to deliver a superior, risk-adjusted investment experience across full market cycles. Basically, it's built to weather the storms, not just to catch the strongest tailwinds when the market is booming.
So how exactly do they achieve that kind of resilience? Let's open the hood and see what's actually inside. The fund's whole strategy relies on spreading investments across multiple asset classes, ensuring that no single asset completely dictates the portfolio's fate. And the fund managers actively rebalance this mix based on market valuations and where we are in the economic cycle.
Let's break down those specific numbers. As of July 31st, 2026, the fund holds roughly 66.1% in domestic equity, 15.6% in debt, 6.7% in cash and equivalents, and 11.6% across gold, silver, REITs, and other derivatives. Think of this setup like a well-engineered car. That 66% equity allocation, that's the powerful engine driving your long-term growth. The 15.6% debt acts as a sturdy chassis, providing much-needed stability. And that 11-ish% in alternative assets like gold and silver, those are your airbags, literally designed to deploy and cushion the blow when the stock market inevitably hits a major bump.
Now, we need to clear something up right now because we have to shatter a very common myth. A lot of people see words like debt and gold in a portfolio and immediately think, oh great, this is safe and low risk. That is a dangerous expectation to have. In reality, the ICICI Prudential Multi-Asset Fund is officially classified on the SEBI Riskometer as very high risk. This is an actively managed market-linked investment with a heavy equity tilt. Make no mistake, if the stock market crashes, that 66% equity allocation is going to pull the net asset value down with it. It's diversified for sure, but it is absolutely not immune to volatility.
However, that heavy equity tilt isn't an accident. It's actually part of a brilliant, deliberate strategy. It brings us to the fund's secret weapon: multi-asset diversification combined with equity taxation. This specific structural choice is exactly what makes this fund highly attractive to long-term wealth builders in India, rather than them just opting for a standard balanced debt fund.
Here is exactly how that taxation advantage works step by step. According to tax rules, a hybrid fund's tax treatment is entirely based on its proportion of domestic equity. Because this fund deliberately maintains its domestic equity holdings at 65% or higher, and remember it's currently sitting at that 66.1% mark, it is legally classified as an equity-oriented fund. So what does that actually mean for your wallet? It means you get to enjoy much friendlier capital gains tax rates. If you hold your investment for more than a year, your long-term capital gains up to 1.25 lakh rupees in a financial year are completely exempt from tax. Anything above that is taxed at just 12.5%. This completely protects your compounding returns from the much higher slab rates that you'd face with debt-heavy funds. It's a massive advantage.
It's the classic reminder that wealth creation really is a marathon, not a sprint. The historical 15 to 17% compounded annual growth rate this fund has delivered over the last 5 to 10 years is truly incredible long-term compounding. But as an investor, you simply can't just extrapolate that 17% and expect it to magically appear in your portfolio every single year. The future return could be considerably lower. The market is going to have bad years, like that recent one-year lag we looked at, and it will have spectacular years. The fund's job is to smooth out that ride using its multi-asset structure, not to win every single lap of the race.
Which leaves us with the ultimate question you need to ask yourself today. Is your investment timeline long enough to let this fund do its job? If you're going to need this money in 1 or 2 years, a massive, very high-risk, all-in-one fund might not be your best bet at all. But if you have a 5, 7, or 10-year horizon to let that equity engine roar, let the debt stabilize things, and let those tax advantages compound over time, this fund offers a genuinely fascinating, structured approach to wealth building. So take a hard look at your own financial horizon and see where a strategy like this might fit in. Thank you so much for joining me on this explainer today. Keep learning, keep analyzing, and I'll see you in the next one.